In America, the standard deduction can quietly change the tax picture before most people even notice it. It is not a coupon, not a refund, and not free money. It is a basic part of how taxable income can be calculated on a federal tax return. For many U.S. women, understanding the standard deduction is one of the simplest ways to understand why gross income and taxable income are not always the same number. When you look at a W-2, a 1099, or a final December pay stub, you see your total earnings for the year. It is easy to assume that this top-line number is the exact figure the government uses to calculate your tax bill. But on a federal tax return, gross income and taxable income are distinct metrics. They are separated by specific rules filtering your earnings down to a smaller, taxable base. The standard deduction is the primary bridge between those numbers, applied to nearly 90% of households. Recognizing the gap between what you earn and what is actually subject to federal tax is the first step in moving away from a passive reading of your tax documents toward active financial literacy. Instead of viewing a tax return as one massive, overwhelming math problem, it helps to look at it as a sequential pipeline. Gross income flows in at the top, filtering through allowable adjustments to emerge as a smaller pool, adjusted gross income. From there, AGI hits a massive checkpoint, the standard deduction. This subtracts a predetermined amount, yielding the final, smallest pool, your taxable income. When you reach this checkpoint, the federal tax code presents a fork in the road. You must choose between applying that flat standard deduction or calculating your own itemized deductions. Itemizing means you manually add up specific, qualifying expenses from your year. These categories commonly include mortgage interest, certain state and local taxes, and charitable contributions, as well as some medical expenses. The math dictates the path most households take. If your total itemizable expenses do not add up to a number larger than the flat standard deduction, you simply claim the standard deduction because it shields a larger portion of your income. The standard deduction operates as a built-in structural shield. It ensures that a baseline amount of every earner's income is protected from federal income taxation before the math even begins. The standard deduction is not a single universal number for everyone. Its size depends entirely on your official filing status. Here are the exact standard deduction rates over 3 years. In 2024, the baseline was $14,600 for single filers and $29,200 for married jointly. Notice the upward trajectory. By 2026, these rise to $16,100 and $32,200. The IRS adjusts these amounts annually for inflation. While tracking those numbers is straightforward, they frequently get entangled in a major point of financial confusion, the difference between a tax deduction and a tax credit. A deduction lowers your pool of taxable income before your tax is calculated. A credit operates later in the process. It reduces your final tax bill, dollar for dollar, after the tax calculation is complete. Misidentifying a $16,000 deduction as a $16,000 credit will lead you to drastically overestimate your potential refund or misunderstand your total financial obligation for the year. The pipeline and the rates we've mapped out apply strictly to the federal tax system. The IRS governs this specific set of rules, which is only one layer of your financial reality. State taxes operate on entirely independent rulebooks. Depending on where you live, your state might mirror the federal standard deduction, establish its own unique limits, or forego levying a state income tax entirely. Navigating these separate layers is a practical reality for women managing their careers, planning their households, and directing their own financial futures. Grasping the underlying math of the standard deduction removes the intimidation often attached to federal tax documents. It clarifies exactly what a W-2 or a 1099 represents in the larger equation. Knowing your filing status and the size of your standard deduction gives you a predictive tool. It allows you to visualize the map of your financial year and anticipate your taxable income long before tax season arrives. The standard deduction may read like dry accounting terminology on paper, but understanding how it functions is the absolute bedrock of navigating the U.S. tax system with independence, accuracy, and confidence. This is educational content, not personal financial, tax, legal, payroll, employment, retirement, or investment advice.